Let's talk about chapter one. Chapter one is what I'll say a foundational chapter. We're kind of just setting the table. Here's what this finance thing is. So we'll just kind of talk about finance from a very intro level here. And the topics we'll get into, what are business forms, what's the objective of finance, how do we figure out what something is worth, and a little bit about financial markets and institutions. So very much an intro type chapter. And for those of you who've recently done the prerequisite, you'll see there's a lot of similarity with this chapter. So what are we trying to figure out? Why is corporate finance important to all managers? So keep in mind at the master's level, only maybe a small handful of you work in finance or maybe ever will work in finance. We totally know that. We just want you to be aware of what does finance do so that you can identify your role in your business organization and you understand how you need finance to help you do what you do and how finance might need you to provide information so that they can do what they do. And there's more of a partnership and collaboration as opposed to building silos and I just know what I do, that's all I care about. You do your thing, I don't really care. That's not going to be conducive for business. Everybody has to cooperate, work together. And if I understand what other departments do, it's just better for everybody. So a lot of this chapter is we're just going to try to figure out what are those finance people doing. So if they ask me for information, I have an idea. I know how to help them now. As a master's student, I think that's very important. So they're trying to figure out strategies that will add value to the firm. Okay, so high-level corporate strategies. You'll talk more about corporate strategy in the strategic management class. If you haven't had that yet, you will talk about that. And then companies are always trying to figure out what should we invest in? What kind of projects and initiatives should we be undertaking that will make the company worth more, add value to the firm? And then we also need to figure out what's the future look like. So we're going to forecast. We're going to figure out our cash position down the road, our cash needs, if we have excess cash, and trying to figure out if we need extra cash, how will we get that? If we forecast we're going to have extra cash, what should we do with it? So finance is doing things like that also. Okay, and the basic business forms are on your screen right here. Now this class will be more of a corporate finance class. That's our take on finance. Most MBA classes are probably going to focus on corporate finance. But we need to be aware of sole proprietorships and partnerships because they're very important. So if you really are not sure what those are, you'll have to know to answer some homework problems, obviously. And so they're going to walk us through just the basics of what a sole proprietorship is. Obviously, it's one person. And now a partnership is two people. So a proprietorship is one person. If you're just starting a business on your own or maybe a hobby business or something you're doing on the side, most likely you're setting that up as a proprietorship. Easy to form, almost no regulation, and no corporate income tax. Any money you make flows through to your personal tax return. You would file a Schedule C and attach that to your 1040, your personal return. And any money that you make, any profit or loss from your Schedule C will flow through to your personal return and you'll pay tax there. The business itself doesn't pay tax, the owner does. Disadvantages, limited life. If the owner dies or just says, I'm done doing this business, the business ends. Unlimited liability. And so if you get sued and you don't have good insurance, that'd be an issue. If you borrow money from a bank for your small business and your small business cannot pay the bank back, the bank will come after your personal assets. And it's hard to raise capital. Really about the only means of raising capital would be personal investment if you happen to have that, or bank loans. And there's really nothing else on top of that. So a lot of businesses will start as a sole proprietorship or a partnership. Partnerships typically start when two people who know each other get together. They have an idea. Quite often partnerships are one person has the idea, the other person has the money. So one person might be more of the investor. The other person might be more the hands-on day-to-day operations person. There's no right or wrong to how that works, but that's not an unusual way to go. Or sometimes a company starts out as a sole proprietorship. That sole proprietor realizes I need help. I'm going to seek investment. and I find a partner to invest in the business, and now I've got some capital and somebody else to help me out. Typically then when you get larger, you become more of a corporation. It's a separate legal entity, separate from its owners and managers. So you file papers of incorporation with the state, whatever state you choose to do business in. You go to the Secretary of State of that state and you file all the needed paperwork and documentation. And then most states want you to file some kind of a charter and a set of bylaws. And the bylaws will kind of say, here's how we will govern the business, more of an internal governance type of a document. So corporations are not perfect. The advantages are good. Unlimited life. If you're a stockholder of a company, so for example, if I own shares of Apple, personally, if I were to pass away, obviously we all know Apple will keep on doing what they do. My heirs would just simply inherit my shares of stock. It's really easy to buy and sell shares of stock. It's much harder to sell a partnership or a proprietorship or buy into it, because what's it worth? I don't know what's it worth. With stocks, we always know what they're worth. They trade every day in public markets. Limited liability, again, if Apple were to go bankrupt, my shares would be worth zero, but none of Apple's creditors can come after me personally. This won't happen. They can't do that. And then the ease of raising capital, I can now issue stock, I can issue bonds. It's the corporate form is the best form for raising capital. Disadvantages, though, is there's that double taxation. So sole proprietorships and partnerships, just the owner pays the tax on the business itself does not pay tax. Corporations, though, do pay tax. They're separately taxable entities. And then the owners, shareholders, so as I mentioned, I own shares of Apple. When I receive dividends, which I do every year, I pay tax on the dividends. So that's that double taxation. Plus, the corporate form is very expensive. It requires a lot of filings with the SEC. You have to have a much larger accounting department, internal audit department, legal department, compliance. The cost of doing the filings, the cost of audits can be millions of dollars per year. So it's an expensive form. And that's why only bigger companies do that, because it just adds more overhead to the business. So becoming a publicly owned corporation means you do an IPO, called an initial public offering. And you hear in the news every so often about an IPO. I'm sure everybody's aware of what Lyft and Uber are, those companies. Those are fairly newer IPOs within the last year, roughly. They've gone public. They've existed for quite a while. They just got to the point where they felt like we're ready to go public, meaning we'll sell shares of stock to the public. In exchange, the public gives us money, and then those companies use that money for various initiatives to grow the company more, try to add value to it, and so on. And you can issue shares as much as you want to. Most companies will do that initial public offering, and they might wait a few years and then sell a few more shares if they need more funding or need more capital and so on. And you can also issue bonds and borrow money too as a corporation. The reason companies sometimes go public is right here is the company has done well, it's very successful, and the founders want to get out, or not necessarily get out, but have an exit strategy. So when they go public, some of their ownership interest then turns into shares of stock, which they can then choose to sell if they want to at some point in time down the road. Okay, so again, with a corporate form, we have what we call the agency problem. And the agency problem is, I would say the vast majority of time, most people make decisions based on their own self-interest, right? That's kind of just the normal behavior that most of us will do is, I need to look out for me. I'm going to make decisions that are good for me. So if I'm in management of a company and my performance is very important for me to get promotions, raises, and to stay employed, which are all important things because probably supporting a family, a mortgage, I like food, clothing, and shelter. Those are nice things. I want a job to have those things. And so the agency problem is that a lot of people act in their own interests and they make decisions that are good for them in terms of their employment and their ability to move up the chain and make more money. However, that could potentially be counterintuitive to the best interest of the owners of the company, who are the shareholders. Okay, so corporations are set up that obviously stockholders are the owners. And one of the benefits that stockholders have is that they get to vote for who's on the board of directors. So based on the number of shares you have, you vote for who's on the board of directors. And so by making those votes, you elect people on the board whose job is to make sure that the company's management is looking out for the best interest of the shareholders. Okay, and so that's called corporate governance, and the rules that are set up to control behavior of the company's board of directors, managers, employees, shareholders, creditors, consumers, competitors, the community, all the stakeholders that have some interest in this business. Okay, you don't have to be an owner to have to be a stakeholder. If I live in a city where this business is a large employer, I'm a stakeholder, right? I want this employer around because it employs a lot of people, and that's important for the community that business is providing jobs. Those people that work at that business are now shoppers at other businesses. Their kids are going to schools. They're paying property tax, sales tax, and so on. And that's important to me. So if I'm a shop owner and I'm relying on people buying things from me, I'm still a stakeholder of a corporation. So kind of keep that in mind too, and how big picture this can really be. Okay, so corporate governance helps control the agency problem and tries to make sure that managers make decisions that are ultimately in the best interest of the shareholders. So it says the primary objective of shareholders should be wealth maximization, right? When you buy stock of a company, you want the stock price to go up over time. That's the reason you buy stock. I want that to go up. And there's a really good chance you own shares of stock of a company. If you have a 401k and you've directed your 401k monies to go into mutual funds, you now are a stockholder. So most likely everybody who is taking this class has a 401k, and you're using that 401k is buying mutual funds, and mutual funds buy stocks. And so everybody wants stock prices to go up because your retirement is depending on it. So at the same time you want a company to maximize its stock price and make decisions to add value to the company, you also want the company to do so ethically, right? We do not want the company to cut corners. Boeing has been in the news the last year or so, and it seems like they've made a series of very bad decisions, potentially some very serious unethical questions or decisions that have resulted in, a while ago now, 2 planes crashing, but their 737 MAX jets have been grounded for months. And as the FAA investigates, they're realizing that internally, upper management made some very poor decisions that maybe are very unethical and have resulted in loss of life and resulted in loss of value to the company. So you don't want to cut corners. You want to do things the right way, behave responsibly, set good examples, be an example company, be a company that people are proud to work for, proud to own shares of stock of. So there is a responsibility that companies have to society. So Boeing had a responsibility to society because Boeing knows that people will board their planes to go from point A to point B, and Boeing needs to have a plane that's 100% as reliable as possible, that people can count on getting them from point A to point B safely and not falling out of the sky because there was some design flaw, some software issue, whatever it was that caused the issue. So yes, you have to behave honorably and ethically to add value. You can't cut corners to do so. I'm a big believer in that. It says here, employment growth is higher in firms that try to maximize stock price. On average, employment goes up in firms that make managers its owners, and then firms that were owned by governments but have been sold to private investors. So there is studies that show that if management can also be owners and they treat the business as owning it, employment growth is higher, the company performs more or performs better. It's not unusual for publicly owned companies that employees are allowed to buy shares of stock, for example, or gifted shares based on performance and things like that. And then again, it says here, consumer welfare is higher in capitalist free market economies than in communist or socialist economies. And if you don't believe me, look at Cuba, look at Venezuela, and I think you'll see that we are correct. So I hear capitalism isn't always the in flavor for younger people, but I will tell you that the things we have today, the resources we have today, the technology, the way of life that we have, is because of capitalism. And so it may not be perfect, but I think it works pretty well. And so it says here, Fortune does a ranking every year of most admired firms. And in addition to high stock returns, these firms have high quality from customers' view. They want to buy the products and services of these companies, and employees who want to work there, they take pride in working there, and they enjoy working there. What three aspects of cash flows affect an investment's value? Okay, so in finance, we're going to learn that you value a company based on cash flow. Okay, so cash flow can be estimated. We're going to figure that out. So what aspects of cash flow affect the value of a company? Obviously, bigger is better with cash flow, right? I want more cash. Bigger is better. The timing is better. I want more cash sooner than later. And then the riskiness of the cash flows. The less risk, the better. So a company will have more value if we're projecting bigger cash flows sooner with less risk, right? Think of your paycheck, okay? Your paycheck is a series of cash flows. And think about your paycheck and how you add value to yourself. Well, a bigger paycheck means I have more value. I can do more with that cash that I'm receiving. The timing of cash flows, do I get paid every week, every other week, twice a month, or monthly? Obviously, you'd want to get paid as often as you can. That's much better than getting paid once per month. And the riskiness of the cash flows. Is my paycheck set in stone? Is it going to be the same every month because I'm salaried? Or am I commissioned? Or is there overtime that I get paid for? You know, that's potentially part of the risk of that. So just think of your personal cash flows, and it's the same thing for a business. Okay, so the concept of free cash flow. Free cash flow is cash available to be distributed to shareholders that will not negatively impact the business. So it's cash that can be taken out of the business, and the business will still be able to maintain its current capacity. Okay. Now keep in mind, things are always wearing out. Okay. With every business, even if they're not necessarily trying to increase capacity, you need to maintain capacity. If I'm a manufacturer, it's safe to say that my machinery needs routine maintenance. It's safe to say that some of my machines will need to be replaced every year because they just hit the limit of their useful life, or new technology is available that will allow me to gain some efficiencies. Parking lots need repaired, buildings need new roofs, just things like that. So I do know that every year there's going to be a certain amount of projects, and some are more just maintenance projects, where I still need some cash available to maintain my current capacity. Okay, so free cash flow is any cash I can take out of my business on top of that and not harm the ability to maintain capacity. Now, if I give away all my free cash, though, it's going to be hard for me to grow and add capacity. So keep that in mind. But free cash flow itself, the concept of it is the cash you could take out, give back to your shareholders, and maintain capacity. And the formula is right here. It's my sales minus my cost, minus taxes, minus that required investment in operating capital. You know, the investment I need to make sure my machinery is running well, old machinery is replaced with new machinery, da da da. Okay, that's what free cash flow is. And then we talk about what the WACC is, the weighted average cost of capital. And it's basically the cost of acquiring capital. There's always a cost of capital. So whenever a company is spending money on capital projects, long-term projects, that money had to come from somewhere. Okay, that money could come from selling stock, issuing debt, using the company's own retained earnings that it's kept. But no matter what we use, there's a cost to it. And that cost is affected by the company's capital structure. How much debt versus equity does that company carry? What's the interest rates in the current economy? Interest rates ebb and flow. They go up and down. How risky is the firm? Some firms are just riskier by nature. If you're a tech company, you probably have a lot more risk than if you are a utility plant. If you're making electricity, there's probably not a lot of risk there. If I'm a tech company, there's probably a lot of risk there. And then what do investors feel about risk? Risk goes up and down. You know, in a booming economy, people are okay with more risk. If we're in a recession, people hate risk, right? So there's always the attitude about risk is continuously changing. So you value a company by saying, what's the present value of all future cash flows? And you can see here, I just take FCF, free cash flows, for year 1, year 2, all the way to infinity. When you see the sideways 8 right there, that's the infinity symbol. So we're saying, what is the free cash flow of this business for the rest of its life? How do you figure that out, right? Well, that's not easy. It requires a lot of guesses and estimates, but it can be done. And so the value of a company is based on this slide here. We're going to use this slide in several chapters, and every chapter will kind of drill down into one concept of this. Right now, we'll look at the big picture of it, but in future chapters, we'll look at specific smaller slices of this. So free cash flow is up here. My revenues minus operating cost and tax minus required investment in operating capital is my free cash flow. The value of the company is the sum of all free cash flows divided by the WACC and the time. And the WACC is determined by all kinds of things: debt equity, the riskiness of the company, market rate of interest, and market risk aversion. And it all goes into the cost of debt and equity, which then creates what the WACC is. Okay, and then a part of finance too is matching suppliers of capital with users of capital. So who are the providers and savers, and who are the borrowers of capital? So households typically are net savers, and non-financial corporations are typically net users, they're borrowers. Governments, unfortunately, especially the U.S. government, is a net borrower. Some foreign governments are net savers. And financial corporations are, it says here, slightly net borrowers, but almost break even. So think like insurance companies and banks would be kind of the financial corporations. So the allocation process, how does money go from suppliers of capital to users of capital? And there's no right or wrong way. It's just there's several ways that it might happen. Direct transfer is one. As a business, you would go to somebody who has money. I used to work for a couple different insurance companies. Insurance companies produce a lot of cash. They have a lot of free cash flow, and they have to invest that cash into smart investments. And so quite often, working for these companies, businesses would just come to us directly and say, can we make a deal? Would you give us a mortgage for our factory? We want to add on capacity. Would you lend us money to build a new factory? You know, the answer is maybe. But if we do a direct transfer, there's no middleman who gets a cut. So the business that's borrowing in that example will hopefully pay less because they're not paying a finder's fee or a commission to somebody else. Usually when a business issues stock, they go through an investment bank because the investment bank knows how to do that. They know the process of measuring risk, determining what the stock price should be, doing all their regulatory filings. And they help a business navigate that. And then, of course, they get a fee because they're taking on risk by doing that. They have to be paid for the risk they took on. So investment banks do that. And just think of yourself when you bought a house or you buy a car. Where did you go to get help to do that? Well, probably a bank, right? You might have went to a bank and said, "I'd like to buy a house. I need a home mortgage." And the bank goes through a process to figure out if you're worthy and your credit score and how much you can afford and what your income is. And they make that decision with you. And then, of course, you're borrowing from the bank. But the bank can only lend to you if it has reserves. And the bank only gets reserves because people have put their money into the bank by having deposits, certificates of deposit, savings accounts, and so on. So, but that's that process of transfer from users to suppliers of capital. In our economy, in any capitalistic economy, that has to be efficient. It has to be a smooth and easy process to get a loan, to get capital. If it's hard to do, the cost of everything goes up. So I used to work in construction. Every time we put a shovel in the ground, there was a bank behind us that lent us money to build a building. So without that, we would never been able to build a building. And every time you build a building, well, that employs people to build it. A business will now be in that building, and that's going to provide jobs. Or we're building an apartment building where people will live. And so you have to have that. And the good news is there's dozens of banks to choose from. So banks are competing with each other to offer deals that make sense for people who need that capital. Okay, so cost of money is interest rates. So we all know that when we borrow money, there is a cost of capital. We have to pay back interest to do that. So if we have a home mortgage, we have an interest rate, so we're paying back principal plus interest. And then it says here, what do we call the price or cost of equity capital? That's stocks. That's cost of equity. And the cost of equity has really two components to it. So it's called the required return, which is both the dividend yield and the capital yield. And then what four factors affect the cost of money? And it depends on what are the production opportunities. What opportunities exist for people who need capital to turn that capital into something that will have value. So building buildings, investing in machinery, adding locations, investing in research and development. The time preference for consumption. Is it now? Is it later? How much risk is there in doing whatever the projects are? And then what do we think inflation will be in the economy? Those all matter. And then economic conditions. It says here, what economic conditions affect the cost of money? Well, hopefully everybody's heard of the Fed, the Federal Reserve. It's a quasi-government organization, regulates banks, and determines what the interest rates are when banks borrow money from each other. Banks can borrow from other banks so that they have reserves available that allow them to give out loans. And the Fed determines what those rates are. And the higher those rates are, they get passed on to you and I as consumers. So the higher those rates are, the more we pay in interest, and the lower we pay, and so on. Obviously, the federal government is working in a budget deficit and has been for a long time. That affects the cost of money. The level of business activity, if we're in a recession or a boom, that definitely matters. And then international trade deficits and surpluses all matter. So there's lots of things. It's not just things that happen domestically in the U.S. that affect interest rates. It's international things affect that too. So the last part of the chapter kind of covers financial securities. What are the things that you can invest in? If I'm a corporation, what can I do to raise money? If I'm a saver, if I'm an investor, what can I put my money in? And this explains a few, and they're all defined in your chapter. So I'm not going to go through every nitty-gritty definition. They're all within chapter 1. You can look them up and take a look at them. But debt is over here, and equity is here. Anything that's money market is short term, 1 year or less. Capital markets is anything long term. And equity is considered to be capital. Okay, so just kind of keep that in mind. So long-term bonds, duration of more than 1 year is capital. Short-term bonds and the other investments are money market, which means they're short-term. Then financial institutions, that's your local bank, the bank on the corner. Investment banks, which help more businesses. You have different kinds of banks. You have what they call savings and loans, mutuals, and credit unions. These are more owned by the depositors, whereas most commercial banks are owned by stockholders or individual people. Life insurance companies, they provide a lot of cash. I used to work for a couple different life insurance companies, and they cash flow. They have to invest the extra cash that they have in marketable securities and investments to have the money available to pay for claims. Mutual funds, everybody who's listening to this, if you have a 401k, you have a mutual fund. And your mutual fund may be putting some money into an ETF, an exchange-traded fund. And that's basically it's a stock that gets you the market. So let's just say the S&P 500 is an index. And it measures the performance of a bundle of 500 stocks. And if you're okay getting whatever the return in the S&P 500 is, you can buy what they call an ETF, which will give you that. It's kind of it's a bundled security that will give you the return on a particular market. Okay, and there's all kinds of variations of those. Pension funds, not many people have pensions anymore. If you work for government, you probably have a pension. If you work for a company with a union, you probably have a pension. Then you have hedge funds and private equity funds. And these are more private investment companies. They basically take individual people's money. They take that money, they pool it, and they find investment opportunities. And then markets, if you went to the store, that's a market, right? If you go to Hy-Vee to buy something, you are now at a market. And stocks, bonds, some things can be bought that way. You can go to a market to buy something. A bank could be a market. A bank could sell you something. Stock exchanges that have a physical location, like the New York Stock Exchange, that would be a market. Okay, so you can go to a market. You can also buy something online. I'm sure all of us have bought something online. You're doing an online class, so you know how to do that. So it's very common that you'd buy something online. Well, same thing. I can buy a lot of my financial assets online. In fact, most people, that's how they actually do it. Then you have physical assets versus financial assets. So a physical asset would be something I can look at, see, and touch, right? And there are investments that are like that. I could invest in art, jewelry, collectibles, antiques, real estate. Those are all types of things I can invest in that hopefully get me the return that I want. Or I could invest in financial assets. Now I'm thinking stocks, bonds, mutual funds, ETFs. They're assets, but they're really only represented by a piece of paper or a contract or something like that. Then spot versus future. Spot is I'm buying something right now. Future is I'm entering into a contract to buy or sell something at some point in time in the future. So a lot of grains and commodities, they talk about spot versus future in those. And you can buy a stock by putting in information in your online brokerage account that says, I will buy a stock if the price hits a certain amount, I'll buy this many shares. Or I can sell stock in the future by doing that. And so you can buy stock right now on the spot or in the future based on some parameters that you decide on. And then money versus capital. Money is short-term, capital is long-term, and then primary versus secondary. So when a stock goes public, that's the primary market. So when you buy stock the very first time from a company, like Lyft and Uber have recently gone public, so when they sold those shares the day they went public, that was primary. They received the dollars on that date. After that, those stocks trade on a market, on stock exchanges. And if you were to buy shares of Lyft or Uber today, you're just buying them from somebody else who already owns it but wants to sell. Okay, that's all you're not buying it directly from the company. Those public companies only get their money the first time they sell a stock. After that, they don't get anything when the stocks buy and sell between different investors. So kind of keep that in mind too. That's important to know that. And you'll get that question in your homework for Chapter 1. And so they talk about that right here. Okay. And then trading, I've already mentioned a few things about that. By location, exchanges that have a physical location. And those still exist. But nowadays, the vast majority of things are done online. It's just so much easier to do now. And if you have TD Ameritrade or Schwab or any of those, I use TD Ameritrade. All you have to do is have the app on your phone, and you can buy and sell to your heart's content. So that's the vast majority of people just do that electronically. Could you go to a broker? Yes. There's not that many physical brokers anymore. Could you call and make an order? Yes. But the vast majority are happening electronically now. So I've already talked a little bit about the market and some of these orders, but a market order is I'm going to buy a stock for whatever it sells for right now, or I'm going to sell a stock for whatever it's selling for right now. A limit order would be I'm protecting myself. Like if I own a stock and I'm worried about the price dropping, and I don't want to have to sit there and watch it like a hawk every minute of every day. Nobody's got time for that. I can put in my brokerage account, I could tell my broker, if the stock hits a certain price, then sell. So maybe I own a stock that trades at 75, and I'm worried if it falls to 50, I don't want it anymore. I want to get out. So I'll put in the system that says, if the stock price hits 50, sell. And I can set that to be just for a couple of hours, days, weeks, whatever time period I want. And I can remove it anytime that I want also. And then broker-dealer networks is, again, just kind of that process you go through to buy and sell shares and so on. And stock exchanges need both buyers and sellers. So broker-dealers are the market makers, the people in the middle who match buyers and sellers to each other. Dealers will quite often even hold inventory of stock so that they can easily fulfill an order. So they hold stock more as inventory than they do trying to buy a stock to make money on it. They're really just owning it as inventory so that when somebody wants to buy, they've got inventory to sell. But that's what different broker and dealers are doing. That's kind of what this explains. And I'm not going to cover this one too deep, so you can look at that one on your own. And the various stock exchanges that all exist. The New York Stock Exchange is probably the big one that everybody's aware of and has heard about. And NYSE is the oldest stock exchange. The biggest of the big companies trade on that. The NASDAQ, though, has more listings, typically smaller companies. And a lot of companies might start out on the NASDAQ, and as they get larger, they'll move to the New York Stock Exchange. This kind of just shows the number of listings between the different exchanges right here and what their values are. You can see the New York Stock Exchange has fewer listings, but the value is a lot higher. It's not unusual. Okay, and this kind of just shows you dollar volume of trading. Just more of a just informational. And this talks a little bit more about home mortgages before savings and loans. Obviously, if you're trying to be a homeowner, you need to borrow a lot of money. And obviously, the bank is taking risk on you of collecting on that home mortgage. You have to make your payments. And so what has happened is they securitize. So a lot of banks, if they do home mortgages, they will actually sell your mortgage at some point in time and securitize your mortgage. And that securitization of your mortgage gets turned into a bond, and they sell that bond. And so they're basically cashing out. And then a security is created based on the value of everybody paying back their home mortgages. That's very common. So they just kind of talk about some of that stuff right here. And unfortunately, that didn't work out. And so we had the S&L crisis happen. Taxpayers had to bail that out. And then, of course, we had issues back in 2008, kind of the same story. And just kind of be aware of that. So it created what they called CDOs, collateralized debt obligations. And those securities were based on the value of home mortgages and required that people pay back those mortgages for those to be valuable. And you can really turn almost any kind of a loan into a security, and it gives you some other options right here. And of course, it unfortunately hasn't always worked out. We had the 2008 crisis, and a lot of home mortgage originating companies went out of business, Countrywide being one of the largest ones, because they were writing bad mortgages. They were giving people mortgages who should not have ever gotten one. They could not afford them. They were buying houses that were too expensive. They could not pay back the mortgages. And that's what this is talking about. So that was back in 2008. And several investment companies went out of business. Government took over, bailed a lot of companies out, and so on. So just more be aware of that. It's pretty long ago, but it seems like history repeats itself. So just more of an FYI. Okay, so that was chapter 1. Make sure you also read through the chapter, review the questions at the back of the chapter, review the terms, and you'll be good to go for